I've experienced that too, just on the loan side of like student loans. And I had a very small balance of student loans when I got out of college, but gosh, and I paid the minimum amount because that's all I could afford at the time. And it took years and years, and I didn't even start hacking into the principal at all. I mean, you could look at situations like that. If you go out and you extend a line of credit on your credit card, or you do a cash advance or whatever, you're paying this exorbitant interest rate of 40%, 35%, 25%, and you just pay the minimum. It will take you decades to pay that off. And how much interest will you pay? So it's not like these things aren't out there already. They're already out there, and they're tools. For instance, what I would do was like, I'm going to charge up my credit card, and then I get my tax return in February or March, and I'm going to pay off the balance, right? So that's a tool that I would use when I was younger. I didn't have a lot of cash, but these are tools that people can use to get into a home. And I think that's the big push right now is, look, we don't want people to necessarily pay 50 years on a property, but rather use it as a tool to get some movement going and help them build wealth, because real estate, bar none, is the number one way you can build wealth as a family, as an individual.
When I don't think that and I agree with that 100%. I don't think when the president put this idea out there that it was, I'm coming up with a new loan program that might help somebody. It's a solution for affordable housing. And this is a tool that people can use to do all the things that we've just said. But one of the biggest problems with affordable housing is not the monthly payment, which this will help. It's the down payment requirements that we have in all of these loan programs. So if it's 3.5%, 5%, government-backed loans, it's up to 20%. That is where the unaffordability comes in. Because if you have, what's the number we've been using? 300,000?
300,000.
That's $9,000 to $11,000 down that you have to put down. That's required to get the loan. Then you have closing costs on top of that. Then you have all the other fees for title, for all the services vendors that are helping you. There's so much money required to get into these deals. That should be the side that we're looking at for affordability.
Now, I don't disagree, but the opposite argument would be, well, they don't have any skin in the game. Well, what do you say to that?
If it's affordability that we're worried about and getting people into the ability to have wealth, then we are so debt heavy right now, credit card debt in this country. I think it's, stat I heard was it was the most since the Great Depression or something like that.
I believe it. Yeah.
Then there's no cash on hand. But you're talking about skin in the game. They lose the house if that's the skin in the game. They no longer have that asset. It's just like anything else. If you can't pay, you lose the asset. That's their skin in the game. They've moved into the home. Because once I pay 20% down, I don't have skin in the game. I have equity in the house. Yeah. If I don't pay, that equity's gone anyway because the house is gone.
Sure.
So where does skin in the game come in?
Well, in 2008, when the big crash happened, the first go around, if you looked at the default rates, actually one of the lowest default rates were the zero down loans on the VA side. They actually had some of the lowest default rates. And that was the big argument. Well, they didn't put any money into it. Well, no, it wasn't just that. That was one of the things, but there was all kinds of other factors that contributed to that market crash. But I don't think there's necessarily a correlation to the amount of money you put down in the default rate, the way we're talking about it here for an affordability, for someone getting into a property. Now, it's a little bit easier to walk away from, sure, but you're also walking away from an asset that you've paid on for 3 or 4 years that you don't want to lose the equity that maybe you've built up, even if it was a zero down loan. So I don't know if you can draw that direct correlation, but so I agree with you in that.
Well, I think that the default thing, that's an interesting statistic, but I don't think that if we're talking about affordable housing, everybody, if we keep the same parameters, the same requirements for down payments, the same cost for construction, the same, interest rates that we have right now, who has to suffer to make affordable housing? right?
The builder,
somebody's got to
seller,
suffer. Somebody's got to suffer to get affordable housing. So if affordable housing is the goal, is getting more people into doing exactly what you were saying, Shannon, to have an asset that will appreciate, that you'll gain equity in, that you can actually borrow against, all of those things. If we want more people to get in there, take away a lot of the barriers for entry. So that's the down payment requirement. It's not the monthly. The
Interesting.
The 50-year loan still has a down payment requirement.
Yeah.
But then that only solves the monthly payment.
Yeah.
So that's a wage thing. But if we don't have cash on hand, which most people in the country do not have cash on hand right now, that's the barrier to entry.